Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And you know, when Tori and I were in here last week, I thought to myself, this might be the biggest week of the year as far as news goes. We had the congressional testimony of Jerome Powell and discussing interest rates going forward and government spending and all sorts of stuff. And I thought, what an amazing week it has been. And then nothing news-oriented has happened since then. So that's obviously untrue. I was wrong. Wednesday was not the biggest day of the year. It turned out Friday was. So I figured, what better way to discuss what has happened to the United States banking system than bring in the guy who's been in the precious metals market longer than banks have existed. Rob, thank you for joining me again this week.
Good to be here, Miles. You're only happy when gold goes down. Why aren't you happy now?
I am happy when gold goes down because I am in my 40s and I would like to buy more at a cheaper price. I'm still in the buying phase of gold. You old guys are like, I hope gold goes up. I don't. I want gold to go down.
I just want gold to be stable, okay? I don't want gold to ratchet up
good luck
10%
with that.
in 2
$6
days.
trillion in spending a year.
Telling you.
It ain't stability in gold. That's adorable.
It's ridiculous.
Yeah, that's cute, Rob. I also want to live in La La Land.
Listen, the last time I was on, I ended up somewhere with 250 to 300,000 of my clients' money parked on the sidelines waiting for the pullback.
Yeah.
I was thinking 815, you were thinking 1795, and I was buying the dips for my clients.
How ridiculous does that sound now 2 weeks later, 3 weeks later? We're nickel and diming $20 up and down.
Well, we were, and it was nerve-wracking because I'm like, hey, I don't want to be too cute with this. I mean, we're really close to the base anyway.
Right.
Well, we double-tapped 1815. I still had, I think it was like 75 or 90 left on the table, and I called everybody. I think it was Wednesday or Thursday. I can't remember. I'm like, okay, let's get this done. I don't think it's going to go any lower. Had no idea what was about to happen on Friday.
Neither did anybody else. Most people at SVB didn't know either.
They had 64% liquidity, Miles.
Yeah, and a B rating.
Yeah.
On their credit rating.
Yeah, we would have said that was a strong bank. But David McElvaney and Kevin Orrick really unpacked that. People need to listen to their commentary.
Yeah, we're going to mention it today, what happened with Silicon Valley and some other banks across the board. But as I'm sure you're all aware, you're inundated with news and discussion on what's going on in the banking system right now. And is there an opportunity for this to become a more contagious problem? But we're not going to go too deep into it on this show because Kevin and David did. Now, I'm biased, obviously, but as I've seen thus far, Kevin and David did the best long-form explanation of what's going on in the banking system right now that I've seen anywhere on YouTube.
Agreed.
So definitely catch the McElvaney Weekly Commentary either on YouTube, Spotify, wherever you listen to your podcast from this week, Wednesday, their show.
Now, in the meantime, we've got gold right about 1920, which is breaking above the descending trend line from the last two highs. I'm very optimistic about that. I'm hoping that we stay above 1920. You think otherwise. What do you think's going to happen?
Well, not necessarily. I'm just not willing to stake a claim that we're in breakout territory quite yet personally. I'm definitely not saying gold's in a bear market. I mean, we've been talking for a couple months now. We bottomed back in November. We had a very strong run up until the first week of February, and we've had an incredibly shallow correction back down, barely to around the 382 fib. So my argument has been generally in a healthy market, when you have corrections, they tend to be a little bit deeper, which is why I've been saying for a few months, just if we see gold going lower, that's fine. In fact, that would be healthy. What is unhealthy is when you have a significant move up, like say going from 1600 to 1960 in 2.5 months, and then you only correct down, $150? That's unhealthy. The fact that we only came down to around 1805, 1810, I think we closed at like 1815.
Yeah.
The fact that we only came down to 1800, that's the unhealthy, scary part of this market. That's showing the strength of the long-term bull market in precious metals and the lack of faith in the US dollar that makes me nervous.
Well, how could you think otherwise, Miles? You think we're headed towards unicorns and rainbows?
Of course, it's all unicorns and rainbows. And Janet Yellen and Jerome Powell, they're going to sing us a lullaby and put us to bed, and everything's going to be fine as long as they're in office.
Well, as long as they're in office and you are woke like SVB or like Signature Bank telling Donald Trump his accounts are closed because they don't want to do business with you anymore. But if you're in East Palestine, Ohio with a train wreck and you're not getting any help because you don't count, this is frustrating for people.
Yeah, the irony of one of the authors of the Dodd-Frank bill, Barney Frank, being on the board of directors of Signature Bank, I think is probably my favorite moment of 2023 thus far.
You know, if it wasn't for double standards, there'd be no standards at all.
Yes, exactly. I like it. So looking at the charts, Rob, you bring up the first point we should definitely look at. Trend lines do matter. People care about trend lines. You look at your high back at the beginning of 2022. You look at your high at the beginning of 2023. And we're going to look at a big trend line here when I get to the Dow chart as well, because we also hit a trend line in the Dow. We did come back up into what looks like that declining trend line on gold. And I do agree with you. If we get above this trend line and we hold above this trend line, that would be a first step towards resuming the bull market that we've been on a very short, 6-8 week break on.
And there's no reason for gold to be weak in this environment. We're not talking about a COVID crisis or a war in Europe, which is fundamentally frightening, but we're talking about the largest asset class in the world, the U.S. dollar, and our banking system is looking extremely vulnerable. Now, I don't expect a bank run to ensue, but what I do expect is small and regional banks to be absorbed by the big monoliths.
Yeah, I completely agree. I mean, I think that's one of my big fears and a new precedent being set as of Friday through the FDIC.
Yeah.
The FDIC, to my understanding, is foregoing limits. Tell me if I'm incorrect on this. Foregoing deposit limits.
Correct.
And they've just come out and said, let's make everyone whole.
Correct.
Well, that sets a pretty dangerous precedent.
Correct.
You know, we've always joked about how bank executives are only beholden to their shareholders. Well, now they actually are only beholden to their own shareholders. There's no oversight anymore. If the government is willing to, at the expense of the U.S. taxpayer, make everybody whole. So if that's the case, why even have a bank account?
Right.
Wouldn't it be better if the Federal Reserve just opened their own private citizen bank and we all just used the federal Amero Bank, whatever they would end up calling it? And while they're at it, you know, I hear Joe Biden put a committee together about a year ago to start exploring the possibility of bringing crypto technology into the value of the U.S. dollar. Like, I hate to get conspiratorial here.
Well, I've got a cowboy hat with tinfoil on it, so go for it.
Yeah, I hate to get conspiratorial here, but it almost sounds like those are pieces of the same puzzle.
They are.
I can promise you, if this was a Midwest, Ohio, Nebraska, primarily
red state,
farmer representing,
rancher,
savings and loan, ranching, small town business bank, with maybe a net asset value of $50 billion, kind of a small to medium-sized bank. I can guarantee if that was the bank that went out of business on Friday, the FDIC wouldn't be extending that same kind of offer.
Sadly, I think you're right.
So being that it was SVB Bank, being that it was a significant number of depositors well over the FDIC limits and the FDIC stepping in to make good on everything at the expense of you and me and our taxpayer dollars. Who am I kidding? At the expense, not our taxpayer dollars. Are you kidding me? It's at the expense of future inflation, our children's taxpayer dollars.
Well, we'll end up paying for it in fees, etc.
Oh, sure.
Sad but true. I wish you were wrong, Miles.
And now that it's happened, you can't undo it. You know, it's like the bail-ins in Cyprus 10 years ago. Like, that's an option on the table now for any banking system. So now they can cover it through bail-ins and they can cover it through government FDIC spending to any dollar amount imaginable. So what's the average American going to do? If they're going to protect the big banks and not the small ones, wouldn't you rather be on the bigger ship? So it's the consolidation.
We've already seen yields being chased. I mean, you're only getting 0.75 of a percentage point at a bank, but you can take that money and buy treasuries at 3 or 4 or even 5%.
Right.
So we saw a big drawdown over the last year plus in that direction. And I think that had a lot to do with what's happening now because the banks are scrambling for liquidity.
Yeah. And you can see, just glance at the gold price over the last couple of days. You can see how quickly the American public is going to react to that in the ways that they do.
Yeah. Listen, I appreciate the fact that you want to see gold back to 1850, but I would love for that to happen. I mean, it's definitely possible. And maybe you're right. Maybe it's likely. But why wait for maybe a 3% drop or a 3.5% drop from where we are? Will that matter? I don't think so.
No, you won't remember in 5 years.
No.
I don't remember any price I've ever paid for any gold I've ever bought in the last 20 years.
And so my encouragement to our listeners is like, hey, if this has challenged you, if this has awakened you, don't go back to sleep. Don't hit the snooze button. 2 weeks from now, we'll be dealing with something else. Take this for what it is. We are on a road that is definitely different than the road we have been on. There is change coming and inflation. The best we can hope for is Jimmy Carter inflation. That's the best we can hope for. But we're not talking about a system now where everybody has great freedom and opportunity. We're talking about a system that is closing in around us, whether it's regarding our healthcare or our finances or even our own personal beliefs and viewpoints. This society is closing in on us.
One of the first things our listeners could consider doing, one of the services that we have here at McIlvaney Precious Metals, is we subscribe to a service through Weiss Research that allows us to go through and look through every bank, every credit union in the United States, look at their credit rating, look at their mix of assets, look at their performing versus non-performing loans, how their money is moved around. And we can do that for you and your bank. So we've had a number of clients calling in here over the last few days, just curious about how their bank stacks up and could they be subject to a similar type of concern, or maybe a completely different concern. You know, you're looking at SVB that's 50% invested in the equities market. Well, what about a bank that's 50% invested in, say, the consumer lending category? Where could the problem be there? So if you're a listener to this show, whether you're a client or not, feel free to give us a buzz. We're happy to sit down and chat with you for 5-10 minutes, take a look at your personal bank. And if it looks awful, we might even be able to help you find a better one in your area as well.
Correct.
So moving back to charts, we're not doing great with charts this week, Rob. So you did say before we started recording, you said it's a fundamental show, not a technical show. But there are some technicals to look at, and we've looked at the gold chart already. Silver, actually a little less dramatic when you kind of look at it on a longer scale. Obviously, the percentages are higher, but the percentages are always higher in silver. It's a more volatile metal. But silver still has a ways to go to get back to those like February highs.
Yeah, silver is a sprinter, gold is a marathon runner.
Right. So gold didn't go anywhere near as deep in the correction over the last few months as silver did. Gold came down about a third of what it had gone up. Silver came down over half of what it had gone up. So it will take time for silver to recover the same relative pricing, but the percentages are going to be higher, and that certainly tightened back down on the ratio between gold and silver. Now, if we see breakout territory in gold, you know, above those February highs, we're in the 1960s, we're in the 1970s, 2000s. Yeah, watch out, because that's when silver becomes the sprinter, and silver goes from 22 to 30 pretty quickly.
Oh, yeah, in a blink.
On the flip side, you know, you mentioned trend lines, and I said I'd bring it up again. The Dow Jones Industrial Average hit a trend line of its own today, but on the downside. The Dow has been trending downwards, declining trend line, which it set between the high at the beginning of 2022 and then about July, August of 22. We broke back above it here in November. As gold started going up in November, so did equities.
Yep.
So we broke back above it and we bounced it on the upside a few times. However, every time we've bounced it, we've put in a lower high. So the Dow Industrial Average, to nobody's surprise, is probably not the strongest thing going forward. And I would argue we should expect to see significantly lower prices in the equities market over the next 6-12 months.
Yeah, I think so too. And I think it's going to be a gradual decline. I don't think it's going to be an overnight contagion.
And of course, because of what happened over the last weekend, I was checking out specifically the banking sector, like, say, the Spider Banking Index. I think that's down about 15% in the last couple days, which is not surprising. But as of today, we actually hit the pre-COVID high. So you go back to the early 2020 Trump high. We broke below it a little bit last fall and then bounced back up, but we actually came back to it again. So it's very likely the financial sector could end up leading the charge down if we continue to see a little unwinding in this banking problem.
And then the question becomes, where do people put their confidence in?
Besides treasury bills and gold, I don't know.
I know.
Ain't real estate, not with interest rates going up.
And I wouldn't go long-term on T-bills either.
No, not with interest rates going up.
Well, and that's what Wall Street is hoping for, is that the Fed's going to have to stall or even pivot.
Yeah, we've been saying for a year now almost, who is Jerome Powell going to be when things actually get hard?
And we said this, he'll raise rates until something breaks.
Right. Or he'll man up and just raise rates. We'll see.
Well, if he was manning up and raising rates, he would have gone above the CPI, which is still roughly half of what actual cost of living increase has been. He didn't do that.
True.
Something broke. They're scrambling. They're trying to blame it on the past administration. I think we're at that break. We'll see.
We'll see. We'll definitely know over the next few days.
Yes, we will.
Now, if you're a gold owner, grab your bowl of popcorn and a lawn chair. Give your McIlvaney advisor over here a call, and we can double check your portfolio and just make sure you're exactly where you want to be. And you can sit back and you can kind of wait for the dust to settle, and we'll see where things land.
Good idea.
If you're not a gold owner, give your McIlvaney.
If you don't own gold by now,
give your advisor a call.
If you don't own gold by now, Miles, my goodness.
Right. Well, if you don't own gold, you're probably not listening to this show. But if you happen to be the person that doesn't own gold and is listening to this show, you're on the right track. You know what the problem is. You obviously know what the solution to the problem is. And we're happy to work with you if you want to give us a buzz as well. So, Rob, thanks again for joining me this week. God, 2 weeks in a row. What's happening next week?
We'll see. It's every week, 1 week after the next. It's been weirder and weirder every week.
What is up with March? It's always March. It was March
madness.
Last year. It was March the year before.
We knew spring was coming.
And obviously March the year before that, too, 2020.
Spring has been the strong season for the metals.
And a crazy season for everything else, apparently.
Yeah.
So if you'd like to maybe put a little bit of sanity in your life and sit down and chat about your precious metals portfolio with one of the advisors here at McIlvaney Precious Metals, give us a buzz. We can be reached at 800-525-9556. You can swing by our website, McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks for joining us. Have a great week.